We got the chief investing officer of BlackRock, the world's largest asset manager. We got the world's best hair, Tom Lee. And we got Josh Brown from Ritz-Holtz, all giving us insights and information, honestly, I haven't heard anywhere else, with some really convincing arguments. Now, at the end of the day, we are all here to make money, to create alpha, to be patient, to invest smart, and not to fall for emotional pitfalls. And I think the information I got for you today is going to help you to do exactly that. And with that, let's start with the Chief Investing Officer of BlackRock and what he had to say about the rest of this year and the next 3 years. Check it out.
You know, if you said to me, how much more will I get? And we'll talk about what would you do in a balanced portfolio today? Could you get another 10, 15% of the equity market this year? I don't think it's much of a stretch at all. Could you get a bit more than that? Yeah, I think you could.
10 to 15%, not much of a stretch at all. And that's because of continued earnings power, along with all of these other levers that we see at play, whether it's buybacks and CapEx and everything else.
So I think it's the buybacks. I think it's the fact that the earnings are still pretty good. And listen, I do think as you get to the back half of the year, there's such an incredible focus, which I think, by the way, too intense about where the interest rate is. Mm-hmm. My sense is that we're moving to a Fed that's put the bar high for raising rates and would like to still get another cut or two in. And I think when people see that, you'll get another push in terms of the equity market. Listen, I'm not saying like jump all in today given the move we had, but I do think you can build a balanced portfolio, and I would hold equity certainly for the next couple of years, and they'll do their job. Companies today are not terribly sensitive to the interest rate move. They termed out their debt. You think about how low rates were. Most companies turn their debt out. Actually, a lot of companies are sitting on huge amounts of cash that are benefiting for these high interest rates. The places that are the cyclical parts of the economy are definitely, you've seen some pressure in a lot of the cyclical parts of the economy. You're seeing that now in the consumer. But companies are much more insensitive to interest rates than they've ever been before. Listen, markets will react to it. If you start to get those cuts, markets will react. But I think people will be surprised, like they've been here before, that if rates stay about where they are, the equity market can move along.
This guy told you in mid-April, when everybody were running around like a headless chicken, thinking that the market is about to collapse. This guy, along with Tom Lee, by the way, told you to relax. Everything is fine. Stocks will go higher. 1 month later, 7% of profits on the S&P 500 later. This guy had the right call. And what he's saying is very interesting. We have a lot of money on the sideline. He's saying $9 trillion. Tom Lee says $6 trillion. Some skeptics say, well, it's a lot less because you have to look at the new money that came in for the past 2 years, which is about $1.2 trillion. Whatever the case may be, we have about $1.2 to $9 trillion, depends on who you want to believe, of money parked on the sideline trying to jump back into this market. And he sees this as a massive catalyst, rightfully so, for the rest of this year and the next couple of years. Because this money is going to be deployed over time. You're not going to get a 1.2 trillion dump over the next week. On top of it, he's talking about massive buybacks, which always prop up the market, and a decent earnings season. And when you put all of these ingredients into one soup, you get a really beautiful setup for what he thinks is the rest of this year. Now, according to his prediction, and I'm going to say it verbatim, another 10 to 15% is not much of a stretch at all, and the market might actually go higher. So he says at the very least 10 to 15% from this point on. Now, he also makes a very interesting point about people over-obsessing about the Federal Reserve monetary policy. He basically says, look, guys, if we have a rate cut, maybe even 2, maybe more, it's going to do wonders for the Russell 2000. Those companies, are in a situation where they have to acquire expensive debt because they don't have positive cash flow, some of them, to sustain themselves. That's great. And that is going to spill over to the S&P 500, to the NASDAQ. Everybody's going to enjoy themselves if the Federal Reserve actually drops rates. Good. But what he's saying here is like, look, guys, the big cap, the Mag 7, the big boys, they don't need debt. When interest rates spiked, what they've done is completely switch over from debt to sustaining themselves through their own positive cash flows. That is why, despite very elevated interest rates over the past 2 years, think about it. We had 2 years of elevated interest. The big cap has done nothing to show you any weakness. They just went up for the past 2 years. Now, if that's the case, that's another very interesting argument to this whole, hey, this is a great setup for the market to fly up over the next 6 months, 8 months. And he even says this is the best time to buy great companies and hold them for the next few years because we're about to enter a bull cycle of 2 to 3 years. And I absolutely agree with him. Now, here's one opinion, and a credible opinion, no doubt. But at this point, I want to clue you in what's going on in the minds of the people who make the decisions of what's happening with that $6 to $9 trillion that are all parked on the sideline. Josh Brown from Ritz-Holtz actually gave it away today in a very interesting manner. You usually don't get that kind of insight on mainstream media. People tend to be more plain vanilla. But this guy I like because he basically calls it like he sees it. And when you hear his explanation of why that $6 to $9 trillion has to be deployed quickly, your head is literally going to explode. Check it out.
I don't get more or less bullish based on price action because I'm not a swing trader. And you could pretend all you want that every investment dollar comes into or out of the market based on the fundamentals. But in reality, people have a job to do. And that job is to earn a return on the capital that's been entrusted with them. And that is a huge driver in the second half of the year in both directions. Right? So we saw a washout in October of 2022. This is the reverse version of that. Now you have the Dow, the NASDAQ, and the S&P 500 as of noon today, all making all-time highs together. That doesn't happen all the time. The last time we saw it was March 20th of this year. It's only happened 241 days since 1985. It's a fairly rare phenomenon, but when it's taking place and you're out of the market and or underweight, it's deafening. You cannot sit there and watch that go on, and not just because you feel a certain way, but there's an agency problem in investing, which is when you're running money for other people, they have expectations, and one of those expectations is you better not trail the SPX.
Now, I like this guy a lot because what he told you right now is about 80% of long-term investing. Ignore the price action. Price action, unless you're a momentum trader, is irrelevant. And I agree completely. But what he said, sometimes it is relevant, but not for the reasons you think. He's basically saying, look, guys, there's 6 or 9, depends on who you ask, of trillions of dollars waiting to jump in. People have taken the money out in the beginning of 2023, thinking that the market is going to go down. Something that I also thought, by the way, but I kept my money in the market because I'm a long-term investor. But a lot of pros took their money out, their clients' money out. When you're managing other people's money, you have a fiduciary duty to make the right call. Now, I can say to myself, well, it's a bad year, I'll take it. I'll get it back in the next 2 to 3 years. When you're managing other people's money, it's not just the fiduciary duty. It's what Josh Brown explained in this video. It's actually your job that may depend on it. If you make the wrong call, these are sharks. These are serious heavy hitters. Now, they're looking at you right now. You manage $1 million, 10 million, 100 million, $1 billion. And they're saying to you, look, you took our money out in 2023. You put it in money market accounts. That was a good choice. But now you have a decision to make. The market flew up like crazy. You missed out on 40%. Everybody else, my friends in the Hamptons, all my dinner friends, all my frenemies, they've all made billions, millions, hundreds of millions, thousands. I've made nothing. I've made 5%. They've made 40%. You better shape up right now. If you're going to miss out on another bull cycle and they all make another 20, 30%, and I'm going to make another 5%, again, you're fired. That's what Josh Brown is telling you. He's giving you a rare insight into the horrifying world of money managers that have lots of money in money market accounts and are dying to jump back in. Why? Because their job is literally dependent on it. If their clients miss on 2 consecutive bull runs while sitting on the sideline, undecided, these people are not just getting fired, they're going to get destroyed. They're going to be blacklisted. If you just cost your client 2 bull cycles, it's just as bad for these guys, for the sharks, as losing money. So all this thing bubbling like a volcano, waiting to erupt, waiting to put all this money into action, these professionals are sitting there trying to survive, saying to themselves, well, if we don't do this, we are absolutely screwed. If we don't deploy now and we miss out again, we're absolutely gone. And what he's saying, Josh Brown here, is that pressure tends to mount in the second half of the year. As we're getting closer to the end of the year and to the decision-making time of who gets to keep their money and their assets under management and their carried interest, the decision is going to be much, much higher. So Josh Brown is telling you, if the market keeps going up, if the price action stays positive, then these folks, these professional money managers, from June to December will have to deploy, because otherwise they're gone. It's a very interesting argument, and I completely agree with him. Now, he also is talking about the fact that beyond that, just look at the macro setup. If you look at the macro, it's not horrible. Inflation is at 3.5%. It's not horrendous. Consumer spending is good. Job market is below 4% unemployment. There's nothing in the market economically, fundamentally, macro-wise, to cause a slowdown that might spill over to the stock market. That's a good setup, at least in his opinion. And I tend to agree. Now let's talk about Tom Lee, the world's best hair. And I'm not envious at all. Well, I am a little bit, but I think I give him a good run for his money. He's talking about the fact that we are, right now, in the perfect time to get more bullish. I want you to watch this clip and then let's talk about it. Check it out.
Inflation is now normalizing. The economy is in good shape and rates are so restrictive, the Fed actually needs to cut rates. And that's actually quite good for stocks. Look, if it's a pause, actually it's good for stocks. If it's a cut, I think it's even better. A lot of folks thought this was a ninth inning market expansion or, an extended rally, but the fact that there's still a huge amount of cash that's been accumulating on the sidelines in the last couple of weeks shows you, look, I think there's still a lot of legs to this rally. That's why I think May could not only be strong, but of course, as stocks could do very well into year end. Well, there's a couple of points to clarify. Number one, the median market multiple is 16 times. So is that demanding when 10-year yields at 4.5% since 1928? Actually, the median multiple should be closer to 20 times for the S&P. In terms of earnings dispersion, or the number of companies producing double-digit earnings growth, it actually hit 47%. It's the highest in over 3 years, which means earnings growth is actually accelerating, and that's with 3 sectors with negative 20% growth: energy, materials, and healthcare. And in terms of price action, I think investors need to be mindful when an index or a stock is bumping up against new highs, and then you layer in a dovish Fed. That's not a bearish setup. That would be extremely bullish. It's going to pull a lot of money off the sidelines. So to me, I think the earnings backdrop's been very good. I think people have been misled by oil rising, thinking that's going to cause another wave of inflation, and it's not. And of course, I think the VIX is telling us, conditions are more risk on than risk off.
So Tom Lee is basically saying, look, guys, everybody's looking at this market the wrong way. You're looking at the average PE on the S&P 500 being at 27, and you freak out. But this is mainly the top 7 or 8 stocks. If you look at the median PE, which is the right way to look at this, we're at 16 price to earnings on the S&P 500. And we have at least 50% more to go before we hit the red zone. Everybody knows above 27, 28, it's very hard to make money. This is the perfect time for him to get more bullish. And he's never strayed away from that, by the way. And he got a lot of flack for that, but so far he's been nothing but right. He also says that, look, the big opportunity is in the Russell 2000. That has been completely underperforming, and it will have the biggest benefit from interest rates dropping. I couldn't agree more. But he also says, look, we have good CPI data. That good CPI data basically shows us that there's not going to be any rate hikes for 2024. April CPI confirmed no more rate hikes. Maybe we don't get any cuts, but the rate hike narrative has died about 2 days ago. And if that's the case, that's $6 trillion parked on the sideline, the people who are sweating bullets, the people that Josh Brown was just talking about, now that they know that interest rates are not going to go up and potentially we might not see another heavy dip, they're under even greater pressure to deploy their funds right now. So basically what he's saying is, look, for the next 3 years, we're headed into a bull cycle. This is kind of the midpoint of that cycle. There's still way more room to go for the next year, the next 2 years. On top of it, inflation is normalizing. The economy is good. Same arguments as Josh Brown. And he also agrees with the BlackRock CIO that even if we don't get a rate cut, the market will be fine, because look at the past 2 years. The market has done phenomenally well without the interest rates dropping. And I love how he completely flipped the narrative on the all-time high argument. Everybody's talking about all-time highs. Oh my God, the market is at all-time high. It's scary to invest right now. But he says one thing. Look, if we're at all-time highs with a great economy and a dovish Fed, that's one hell of a good setup. You shouldn't be alarmed. You should be excited for the next 3 years. You should be buying up cloud and AI. By the way, exactly the same thing I told you in yesterday's videos. And that's why people love Tom Lee, because he will always call it like he sees it. He doesn't BS. Now look, most people will find themselves more often than not on the opposite side of a trade because they're too afraid to buy at the bottom when it dips, and they get overexcited when it peaks and they FOMO pile into it instead of doing it slowly. That's why emotional trading is going to keep you broke. I don't want that to happen to you. You need to get comfortable with uncertainty. We talked about it multiple times. You're never going to have certain markets where you know exactly what's going to happen. You need to understand that sometimes you'll screw it up. Sometimes you'll get it wrong. Uncertainty is okay. Be okay with not knowing for sure exactly what's going to happen. And guess what? The best part is you can't lose if you stay long term. Even if my prediction for the rest of 2024 is completely wrong, which it very well may be, even if Tom Lee gets it wrong, even if Josh Brown gets it wrong, even if the BlackRock CIO gets it wrong, if everybody you've heard in this video, myself included, just got it wrong, and 2024 becomes a horrible year, what happens next? Look at the market over the past 100 years. Look at the market over the past 5 years. Wars, pandemics, geopolitical insanity. And the market gave you 85%. So don't forget, the stock market has always and will always be a mechanism to transfer money from the impatient to the patient. If we get this right, and 2024 is a great year, hooray. If we don't, sit back, relax, and just let it climb back up. So I got for you today. I'll see you in the next one.